job, which is even easier. But what about the other third? Well, now we're going closer in time to your era. The Tax Reform Act of 1997. Now who is our president?
Clinton.
1997.
Clinton.
Clinton. Bill, soon to be the First Lady. Anyway, it's Bill. And this disturbed me a little bit. When they put this extra complexity in for corporations, I was not disturbed. Because major corporations have tax professionals who work for the company. When I worked for CBI Industries, I was the tax research guy and the one who handled the IRS audits, but we had a whole federal tax department, and we even had a state tax department. People whose main job was doing that. So I figured, well, you got professionals. But individuals now have extra complexity if they sell a 1250 asset. Now, I'm not sure all the versions of Turbo, I'm sure maybe the top version of TurboTax will cover this, but I'm not convinced because most individuals don't have this. But let's take a look at it, and I'll tell you some my name for it and why I like mine, what the official name has become. Now we're at the top of the sheet. Building 1250 asset, selling price was $550,000, cost was $500,000. This was an acres building, so accelerated depreciation was taken. Straight line would have been 64. We took 116. Adjusted basis 384. Gain 166. How many tiers of gain do we have here for individuals? 3. Tier A we know by heart. It's the excess of accelerated over straight line. That's the same 52,000 we've seen 2 other times. Notice where I hand wrote that, where it says 35%. When this was first typed up, and I don't have this on a flash drive or anything, that said 39.6. But then under George W., remember the rate went down to 35. So next to the 35, put down 35% or 39.6%. This would be whatever your highest tax bracket is. And I would assume that this type of a situation would only apply to wealthier taxpayers. So 35 or 39.6%. Through the end of 1997, we would have gone directly to Tier C. But they added an extra tier. Now, look at Tier B. Don't cross this out. This is not the official name. This is Bill's name, and Bill loves it. Reduced rate 1245. When I first, I went to a CPE credit course right after this legislation, and there were 2 professors from Northwestern who have this every year. And they called it the Tier B fictitious 1250. I didn't like that a whole lot. That's not the name that stuck. So above my reduced rate 1245, without crossing off my name, put down unrecovered section 1250. Unrecovered. That's the name that stuck. I think that's a lousy name, but anyway. Notice that's the total depreciation minus the recapture above. That's taxed at a flat rate of 25%. That's a flat rate of 25%. Let's comment on this a little bit. If you add Tier A and Tier B together, what do you get?
Total depreciation.
Total depreciation. Tracy's right. And under which method of or under what type of asset do you recapture all depreciation? 1245, right? That's why I put the 1245 in Tier B. And under 1245, you could be taxed as high as 39.6%. Here, the maximum is 25. So Bill called it reduced rate 1245. Because basically tier A and tier B are the total depreciation, but the tier B can't be taxed at more than 25%. So I love my name, but obviously it was not adopted. Anything left over is tier C. That would be long-term capital gain. Notice I have 15% put down or 20%. 15 or 20%, because again, probably is going to be higher income taxpayers who would have this situation. Now, on the exam, 1/3 of you will have Zeke the farmer selling a barn. Had an international student once. Said, Bill, what is a barn? Well, I'm an urban boy. To me, it's like a building that houses animals or something. When I was growing up, we're from the South Austin. The only barn I knew was the park at the zoo and the park at Lincoln Park. Well, there was a barn there and stuff. We never went out driving into southern Illinois and looked at all those silos and everything. So basically here, Zeke's going to sell his barn. And I'm going to, well, what's the nature of the gain? And you would do tier A and smile. Then you will do tier B and smile and think. Do tier A as we have it here, excess of accelerated over straight line. Do tier B, total depreciation minus recapture above. But tier A plus tier B would be the tentative total recapture. And behind me, blocking by Bill's body here in red, we said depreciation recapture cannot do what? Exceed, that's right, the total gain realized. And you're going to see that A plus B is too much. What do I do on the exam then, Bill? You'll then plug it. You'll force tier B to a lesser amount. So A plus B will equal then the total gain. You have to break it out separately because tier A is at the higher tax rate than tier B. But instead of 64,000, it may be a lesser number for tier B. What about tier C? There will be no tier C. Now we'll go over that again next week in greater depth. But I want you to, again, to think about it. You're going to do tier A, you're going to do tier B. Just like we show here. Then you're going to see that A plus B is too much, because A plus B cannot exceed the total gain. So you're going to take the excess amount out of tier B, and there'll be no tier C. Now, one last question on this area. Then we'll go to 1231 netting rules. What if we had, on the exam it's an acres building again, what if we had a maker's building today where you can only take straight line? If we had a maker's building sold by an individual, what would be tier A? 0. What would be tier B? See why Bill's name is so good. What would be tier B? Total depreciation. Yes, it'd be total depreciation, but taxed at a lower rate. See why Bill's name is so good? Reduced rate, 1245. They never asked me. I could have given them great advice here. So it's just an idea. I mean, this stuff is confusing. I love it though. And hopefully the software does do a decent job for it here as well. Okay, now, I told you it's going to be heavy duty today. We still got to go, but that handout we're done with now. Many years ago, I'm going to talk about the 1231 netting rules. And many years ago, a student prepared this handout. I can't remember who it was even. It's been so long. I'm not crazy about this handout. But I was impressed enough that I distribute it. And if you don't understand it, you can throw it away or you can look at it. Then we'll look at the board. Then we'll talk about the look-back rule and so forth. There's still some more excitement here. Should I have given you 2 sets of everything? Come up and see me afterwards. I can give
Okay.
you an extra set for Barry. I didn't think about, or would it be easier for me just to give it to him on Monday?
Yeah, just give it to him. I won't see him.
Okay. Now, I'm going to put this aside. You can look at that flow chart type thing if you like. Looking behind me here, this dilemma that we've been talking about all day about, geez, a 1231 asset is not a capital asset, but it might get capital gain treatment. Still kind of confusing. The 1231 netting rules, 2 steps. And again, if you look back to last week's posts, some people posted something like this in the online discussion that we had last week. First of all, net all 1231 gains and losses from involuntary conversions. Many times you won't have any of these. What are examples of involuntary conversions again? I mean, on the example was the eminent domain, but that's not as typical. What are other involuntary conversions? Yes, fire. Or something we've had recently here and even worse in Houston, floods. Isn't this weird? Houston's had flooding, we've had flooding, and California's in severe drought. Can't we send some of it back over by them? Exactly. Tornadoes, earthquakes, asteroids hitting the earth, etc. Very good. So hopefully you won't always have these. If you have a net 1231 loss from an involuntary conversion, you take an ordinary loss and you don't have to consider it anymore. What's the best type of loss to have? Ordinary or capital? Ordinary. Yes, Donna's right, because capital losses are subject to limitations. If you have a net gain from an involuntary conversion, this can happen. I remember many years ago when that Air Florida jet in February crashed into the icy Potomac. That aircraft was insured at replacement cost. They actually had if you don't consider the settlements with the victims, they actually had a gain on the casualty. So if you have a gain on an involuntary conversion, include in step 2. Step 2, net all 1231 gains. Now these are the gains after the recapture. This is like tier C for the 1250 area, or tier B for 1245. Net all 1231 gains or losses from sales, and any net gain. Well, I didn't put from sales down there. I knew I got done too soon. Net all 1231 gains and losses from sales plus. That's what normally 1231 is. Yes, sell it. So net any 1231 gains after recapture and losses from sales, plus any net gain from step 1. If you end up with a net loss, take an ordinary loss. If you end up with a net gain, through the end of 1984 it said LTCG. But then they added subject to the look-back rule. The look-back rule. We'll talk about the look-back rule in a few minutes. Let you get that copy down. I'm sorry I left off the word for sale, from sales. And I want to go back to this original handout to prob number 10. Prob number 10. Sam. Then I'll pass out a handout on the look-back rule I'm not testing the look-back rule, but I want to familiarize you with it. Basically, we have Sam here, and we have 4 situations. Notice the column headings. This one, Sam. Got it now? Casualty and theft. That would be the involuntary conversion. Sale would be the step 2 stuff. I'd like 4 volunteers to take us through the 1231 netting rules. Okay. I had Vernesia grab number 1 right away. Then there was reluctance. But anyone want to volunteer to try this 1231 netting rule applied to this problem? I'll tell you what we'll do. Somebody else who served in the military like I did knows the military method of getting volunteers. Margaret. Well, she can tell you. I need 3 volunteers, you, and you. No, so, okay. Margaret, try and go through this with me here. Situation 1. First of all, do the step 1, which is the casualty and theft. You have an 8,000 gain and a 4,000 loss. Net those. 4,000 gain. Now look at Bill's rules, everyone. If we have a net gain from step, remember we said over here, if we have a net gain, include in step 2. So we're going to put that on the side burner. Margaret, do the 1231 netting for sales. Gain of 50 and loss of 20. 30,000. She's got a net 1231 gain from sales of 30. Pick up the 4,000 that she had from step 1. She ends up with 34,000, probably long-term capital gain. See how it works? Anyone need us to reiterate that? Hey, Bill, this is not easy stuff. No, it is not. Okay, I think we need someone for number 2. Looking for more volunteers. Donna, you're usually willing to do something. Try us out here, please.
Okay. So we're doing this similar to the first one, or the step 1 is the...
Yes, the step 1 with the casualty and theft, and then the step 2. Looking at Bill's easy understood instructions.
We have a net loss of 1,000.
Yes. Notice in step 1, 8,000 gain, 9,000 loss. We have a loss of 1,000. Notice what Bill said. Take an ordinary loss and no longer consider it. So we got a $1,000 loss that we're going to put on the first part of the 4797, page 1. Now go to step 2.
Step 2 is 30,000 gain from sales.
That's right. So that'll probably be long-term capital gain. So notice in step 1 we have a $1,000 ordinary loss. In step 2 we have a $30,000 net 1231 gain. Now someone made a big thing on Tuesday night saying, well, do we add those together? On the 4797 they're basically in separate parts. Now at the bottom of page 1 it would say like add line 7 plus line 13 to carry over to page 1 of the 1120 or 1040. So eventually those do get added together. But they're basically treated separately because one's ordinary income and the other one, it could be long-term capital gain. Everyone set for number 2. Who wants to do 3? Oh, okay, Lena, yes.
Okay, so first look at the casualty. That would be a $4,000 gain.
Okay, 4,000 gain from casualty.
So we do have to include that in step 2.
Good.
Which is actually a loss of 10,000.
So loss of 10, pick up the gain of 4.
That means you have a loss of 6, so you ignore it.
Well, loss of 6, you get ordinary loss.
Ordinary
yes,
loss.
Yes, ordinary
okay.
loss, that's right. Although that's going to add up to something else in a second. Yeah, Elena's correct. Let's just review what she said. From her step 1, 8,000 gain, 4,000 loss. She has a 4,000 gain. She puts it on the side temporarily. She went to the sale, 10,000 gain, 20,000 loss. That's a $10,000 loss. She picked up the $4,000 gain. She has a $6,000 loss from step 2. Now that will be ordinary loss, but that would be subject in future years to the look-back rule, which I'm not testing, but I want you to know. All right, we have just one part left, and that's part 4. So I'm looking for, yes, go ahead, yes, definitely. Rashad's going to do it.
For step 1, it would be a loss of $1,000.
All right, $1,000 loss from step 1, that'll be an ordinary loss.
And that does not carry forward
That's right.
to step 2. Then step 2 would be a loss of $10,000.
That's right. So notice he has 2 ordinary losses, but they're in 2 separate sections of the 4797. The one on step 2 would be subject to the look-back rule.
Where would that be on the 4797?
Part 1 and part 2, I believe. I haven't looked at the form. I might have the form with me. Let me see. If not, we can always look it up in irs.gov.
I have it right here.
Oh, you have the
Okay.
form?
But what, yeah.
Oh, let
So
me see.
where would it?
Yeah, let me see this. All right. The study guide, which is not a bad idea. Okay, there's the recapture, remember? The recapture part for the, okay, sale, okay, loss or exchange, or sale or exchange of property or involuntary conversions for other than casualty and theft. Okay, ordinary gains and losses. So let me see now. It looks like they actually go down here in part 2. I thought one went in part 1 and one went in part 2, but I think
They're
it's
both
part.
down?
It looks like they're both down there, but I always thought I'd have to look at it more closely. Take a look in irs.gov at the instructions for the form.
Yeah.
The instructions. By the way, that study guide goes with the text. It's a separate purchase. How much did you have to pay for that?
I think I paid like $80 for it.
Oh, that much, okay. It's not a bad item to have, because that's for future reference. Now, anything that changes in subsequent tax legislation makes that outdated, but we haven't had a lot of subsequent tax legislation that makes major changes in these areas because we've had such let's say, a lack of conciliation in Congress and between Congress and the President. It's written by Edward Foth, F-O-T-H, and it accompanies the text. You might be able to find one online that relates to an earlier edition of the book. There's a new edition of our text out, just came out. And I looked at it, and it's basically almost everything is the same as our text, except obviously like the 179 deduction and things that have gone back to smaller amounts are reflected in there. But then again, we'll probably extend, like we did in 2014, what was true for the prior year. So you might be able to get a hold of one of those. And it's just a nice thing to have in your library. Another source, by the way, that CCH has is called the Master Tax Guide. The Master Tax Guide. I have them going back to the late 70s. It was recommended to me when I was in law school. And I get one free every year because I know the publisher. But the Master Tax Guide is even better than the study guide, but it's like that. It's a nice summary of all areas of income taxation with a fancy index and everything in the back. So something to look at. Okay, now, I'm not testing this, but I want to go over it. The look-back rule. Now, every year, as you will have to, I have to go to continuing education courses. I've met my requirement because the filing, we have to file and pay for our new license by September 30th of this year. It's every 3 years. And I highly recommend the University of Illinois Tax School. It's very excellent. It's also relatively inexpensive, considering how these courses, how these items run. You get 16 hours of continuing education credit for about $280. Most Illinois CPA Society items, except for the technology show, are like $320 for 1 day for 8 hours. And this was from the tax school a few years ago. This was in loose leaf, so I was able to pull it out. They had it again a few years later, but I didn't reprint that out. We'll look at an example together. Basically, it says if in step 2 you had net 1231 losses in step 2, that gave you ordinary loss treatment. Then in subsequent years, if you have a net 1231 gain, instead of getting long-term capital gain treatment, you have to recapture the unrecaptured 1231 losses. Carries for at least 5 years. Bill, that was confusing as hell. All right, let's look at the example. Example 2, Jess reported the following 1231 gains and losses. 1998, a 10,000-hour loss. That would have been ordinary loss. 1999, a 10,000-hour loss. That would be ordinary loss. In the year 2000, she has a $15,000 net 1231 gain. Through the end of 1984, if this had happened, that would have been long-term capital gain, but now recapture applies. How much loss has she got from 98, 99? 20,000. So that 15,000 she got in 2000, all of it's going to be recaptured as ordinary income. Plus she's recapturing 15,000, and what were the two 1231 losses she got 98, 99? What did they equal? They equal 20. She's now recaptured 15. So how much more does she have to recapture? 5. So in 2001, when she gets $10,000 net 1231 gain, she has to recapture 5,000 of that. So 5,000 of that will be ordinary income. The other 5,000 long-term capital gain. 2002, she has a 1231 loss of 7. That's ordinary loss. But in 2003, she has a $10,000 gain. How much of that gain is going to be ordinary? What she's got to recapture? Say it. 7. That's right. She has to recapture 7, and the other 3,000 is long-term capital gain. So look this example over. I wouldn't do it with a lot of loud music playing or anything here. I'm not testing the look-back rule. And when this first came into the law in the 84 Act, there was a lot of opposition to it because it's an overreaction. Because most 1231 transactions are not influenced by tax considerations. They're normally operating strategy decisions. But the issue is that they probably don't impact that many taxpayers, because most taxpayers don't end up with that 1231 loss for a particular period of time, so you don't have the recapture then. All right, that was the material out of that chapter. Now I want to go over your exams from last week. And then we'll go into chapter 14 for the remaining time. Any questions that you have? I'm going to take Barry's exam out so I can look it over as we go through it. Look at these areas. We don't have anything but posting for the rest of this week, although some of you have multiple classes, probably have other projects. There's nothing else due, though, for us. Review stuff. See if you have questions. Next week we'll start on Monday in the room next door, 118. We'll start going over the exam. But if there's any questions you have that might be unrelated to the exam, I'll answer any of that for you. I think it should be kind of relaxed basically here. I must confess I missed the times when we didn't have to meet in week 8, but in this class, it's probably worthwhile. Okay, yeah, now you can
Turn it
shut
off.
down.
Okay.